So, किती student? Okay, so we'll wait for another 3 minutes and then I'll start.
Yes, sir. So you can start, sir.
Yeah. Okay, so we start today from master budget. Okay. Okay. See what happened if you like how we are generally do the financial planning in the organization. Okay.
Sir, you are on mute, sir.
Now, okay. So yeah,
Yes, sir. Yes.
yeah. So we start with master budget today. Okay. So what happened in any organization? They need to do like 2 or 3 months before the year starts. Say for we are sitting right now in the month of September. Okay, September 25. Okay, and the financial year may start from Jan 26. Okay, so financial year is basically Jan 26 to December 26. Okay, so what is mostly the process? In the month of October, every company started to do the planning 25. Every company started to do the planning for 2026. So what is their first first approach is basically they are going to prepare the master budget for 2026. So this we generally prepare on the basis of assumptions prevail, okay, as on October 25. Okay. Then how we shift from master budget to flexible budget. Okay. So say for in the month of June, maybe once the year start. So after 6 months, okay, say for June 26. Okay. If, like the companies are going to take a review or the head office is going to take a review, whatever the budget we prepare in October 25 for 2026 is still okay, or there is a revision required. Okay. Driving, I mean, actually, the component or yeah, you can say the component or the factor which drive the budget is always sales. We always start from the sales projection and then we need to find out the production purchases, like administrative expenses, selling expenses. Okay. So it is driving of the budget is sales. Okay. So on the basis of order available or the current situation current situation in June 26, we may change master budget to flexible budget. Okay. So here only we change the sales factor. Okay. What could be our actual sales? Okay. Rest assumption we are keeping as it is. Like the raw material prices, we are keeping whatever the assumption we took in the master budget, that we are not going to change. Okay. Because of situation, maybe the raw material prices get changed, but that we need to see in the like price variation. Okay, so there is a standard costing, I mean, which we are going to see anyhow in upcoming chapters. Okay, so where we consider whatever my standard price, whatever my actual price for raw material. Okay, and accordingly I am finalized what is my price variation. Okay, so only the sales number get changed while shifting from master budget to flexible budget. Okay, rest of the assumption we keep as it is. Rest of assumption we keep as it is. As it is. Okay, so only the sales we are going to change. Why we need to shift from master budget to flexible budget? If I'm not going to produce, okay, so then how could I compare with the actual situation? Okay, if we're not planning to sell, then how I'm going to compare with the actual situation? Okay, so in master budget, if I say for I decided to sell 20,000 quantity, and the change in inventory could be the 2,000 plus. Okay, so I need to produce 22,000 in a master budget. Okay, so just imagine, as per master budget, okay, sales expected 20,000 and my change in inventory, so it is 2,000. So my production plus 2,000 means like closing inventory is more than opening inventory by 2,000. That's why it is plus 2,000. So production equals to 22,000. Okay. So I created all other component of as per the sales of 20,000. But now what happened in the month of June? I realized, okay, we cannot do 20,000. We need to come to 15,000. Rest assumption I may be kept as it is. So production as per June forecast, I am using the word forecast. How much? If I keep the same assumption, okay, the only thing is that I shift sales from 20,000 to 15,000. So what could be my production? And guess, I hope you are able to listen me properly. So it is 2,000 I need to add because my change in inventory I kept as it is. Okay. So the only thing is I changed the sales number. So my production is 17,000 here as per the June. Okay. So what I am going to do, the other component like my production plan automatically get changes. So accordingly raw material purchase gets changed. Accordingly overhead recovery get changed. Accordingly maybe I need to make some adjustment in a fixed overhead like selling expenses, admin expenses. It is like this. Okay, but I keep this as it is. Okay, whatever may be the, I mean, while making an assumption, okay, or preparing the budget, rest I'll keep as it is. Okay, the only thing is that whatever may be the component, I mean, whatever the calculation I did for 20,000, that calculation I'm going to do for 17,000. That is the only change I'm doing. So this is basically from shifting from master budget to the flexible budget. Then in the month of October, while preparing the next month budget, okay, again, like for 2027, I'm going to prepare. Okay, in October 26. So again, I'm doing a further forecast. What would be my December end number? Okay, so at that time I am again going to change my budget, which I finalize in the month of June. June 26. Okay, so this way we need to create a two-time flexible budget. This is the general practice in the organization. So frequency may be changed. Sometime we are doing in a quarterly, sometime we are doing a 6 month in a year, like this. Okay, so it is basically most of the small organization doing first review in a 6 month, and thus after that, after 3 months, they are doing an again review, like this. Okay, so I hope you are able to understand what is the difference in master budget and the flexible budget. Okay, master budget is the primary budget which we prepare before finalizing the next year annual plan. Okay, and then flexible budget is whatever the assumptions we took for the master budget, that the same assumption we are carry forward. The only number changes is arises due to the drop in the sales volume. Okay, so and accordingly we finalize the flexible budget, and then we compare whatever the number as per the flexible budget and the actual numbers. Okay, and we calculate the variances. Okay, so this way we are controlling the cost. Okay, so it is basically master budget considered as the annual business plan. Okay, so that is basically for short-term operating performance goal for the period. So generally, as I already explained, we prepare this for a 1 year only, and sometimes it is less than that. Okay, the plan normally includes an operating non-financial budget as well as financial budget, the outline, the sources of the funds, and the detailed plan for the expenditure. Okay, we start from the sales budget. Okay, then production budget, then purchase, then purchase, after that direct labor utilization or required, because it is budget. Okay, then overhead, both variable and fixed, then SGA, like selling general and admin expenses. Okay, after that capex, and whatever may be the capital plan, and the final is basically the cash flow. Okay, so more or these are basically the standard budget we are preparing, and on the basis of all this information we can prepare the pro forma income statement and the financials. Okay, so this way we compile what would be the my annual financial plan. Okay, so this is basically means all the sales budget, production budget, purchase, direct labor, overhead, both variable and fixed, SGA, capex, cash flow, and then the pro forma income statement and the pro forma financial statement. Okay. Okay, so we generally, I mean, the purpose of preparation of the budget is it gives us the guidance to the organization, means whether we are able to achieve our overall strategic objective, we are able to like means how we are going to achieve the I mean whatever the business plan, how we can make a profit planning, and then whatever the target we need to give the or we need to keep internally. Okay, so this is basically the purpose of master budget. Okay, like flexible budget is a dynamic, but the master budget is basically the static budget, because as I said, means whatever may be the assumption we took in a master budget, that also carry forward to the flexible budget. Only the sales number get change. Okay, so it is the master budget always a static budget. Whenever there is a changes is required, that we need to and we prepare as per the assumption of the master budget, that we called as a flexible budget. Okay, So component, a master budget generally comprises operating budget and the financial budget prepared in the application of achieving a single level of sales volume for a specified period. And the ultimate output of the annual business plan is a series of pro forma financial statement, including balance sheet, income statement, and statement of cash flow. So that we already discussed. Means whatever the planning we are doing, or whatever maybe the individual component we are preparing, and the finally it is end with the cash flow statement, pro forma income statement, and the financial statement. Master budget confined to 1 year at a single level of activity. So generally we prepare for the 1 year only, and the reporting output, the product of the process is set of a pro forma financial statement. Although familiar pro forma financial statement may not be provide the type of management information most useful in decision making. Okay, see what happened means we prepare the master budget. The basic intention is whatever may be the financial plan we need to do, okay, or my financial statement look like that indication we need, okay. So that is my output. So as okay, so like operating budget, we need to start with the sales budget. Accordingly, we need to calculate the production budget, selling and administrative budget, and the personnel budget. So generally, like sales budget, we can calculate on the basis of probability. In the last class, we already saw that probability or some expectation. Okay, and accordingly, we need to calculate the production budget. So production budget generally, it is basically the sales budget plus minus expected change in inventory. Change in inventory. Change in inventory means whatever may be my opening stock. Okay, this is we are talking about finished good. And whatever may be my closing stock. Generally, it is positive. Very rare it happen, it is negative basically. Okay, so why it is mostly positive? Because we always see the growth in upcoming years. So that's why we may expect or estimate the higher volume in a subsequent years. So we need to maintain the higher stock. Okay, so that's why mostly it is positive. But if you foresee there is a discontinuation of the product, there may be a certain economic environment where we expect that the demand for the product goes down. So in that situation, there may be a negative change in inventory. Mostly it is a positive change in inventory. So selling and administrative budget, this is basically the fixed budget or fixed expenses. So that we need to prepare on the basis of trend in a past year plus any major variation expected. Okay, say for expected. Okay, say for you are calculating the professional fees. Okay, we are preparing the budget for the professional fees. So what happened? Currently, you may incur the 10 lakh. Okay, but this year onwards, okay, means if your turnover increase from 150 crore to 220 crore, okay, 150 crore to 220 crore. So additional rule applicable, like if you cross the 200 crore, then you need to maintain a internal audit department. And if you decide instead of maintaining internally, you can outsource this to the practicing internal auditor. So in that situation, you need to pay the additional fees to him. So what happened? I mean, we need to analyze the scenario this way, and if you find that any additional or the current circumstances may require, we need to engage or we need to make an additional expenditure, that also you need to add. Say for we need to pay them a fees of 5 lakh. So this year you need to make a budget for 15 lakh. So this way you need to do. Okay, so selling administrative budget, it is mostly a fixed kind of budget. You need to evaluate the past year trend, and accordingly you need to decide what would be the current year. Means every year there is a slight increase of say for 10%. So whatever may be the last year expenses, you can increase by 10%. Plus, if additional event call for additional expenditure, okay, so then you need to accommodate it. This way you need to finalize your selling and administrative budget. Then personnel budget. So every department, they're supposed to give the manpower plan on the basis of current year sales target. Basis of sales as well as production target. Or current year sales or production target. So if I am going to increase my production by say for the 50%. Okay. So some department may require the additional manpower. Okay. Like the production department may require the additional manpower because they directly link with the end product. But the finance department or HR department or IT department, for them, there may be an additional one or two manpower, but not that much. It is not the directly linked with the production. So every department, on the basis of the expected turnover, they need to give the planning for the manpower, means whatever may be the replacement position, whatever may be the new position. Okay, and accordingly we need to finalize the personnel budget. So, pro forma financial statement, it is more or less a regular income statement and the balance sheet and the cash budget. So, it is more or less like a cash flow statement, whatever we prepare for the annual reporting. So, this is basically, if you see, it started with strategy, means if we finalize what would be my strategy for the next year. Say for I decided, okay, I want to add additional product line, or I want to, whatever the current production or the current product line I have, I need to increase. I mean, there may be a certain organic growth. Then it may possible I am going to add additional region. Okay, so like see, object is like this year we are operating 10 products. Okay, it may possible that we are going to add additional 5 products. Additional 5 products. So this is basically the strategic decision or the mission, I can say. We may enter in additional geographical area. Graphic area. Okay, so that may be the one more strategy. Okay, then anyone can tell any other strategy beside increasing product line, increasing sales by entering additional geographical area. So any additional strategy, because of that reason we can increase the sale. Acquire of the company or acquiring competitor or supplier. So these are basically the strategies which we need to consider, and whatever may be the impact because of this strategy. Say for if I'm adding the additional 5 product, then I need to incur the additional expenses in the marketing. Okay, if I'm developing the product, then there may be an R&D. Okay, so we need to see whatever the expenses we need to do on all this department, whether there is any revision required or the current year means whatever maybe the past year trend, we need to go as it is. Okay, if we enter in an additional geographic area, we need to add some volume. But again, it calls for additional expenses. Means we need to follow their rules and regulation. Okay, so that is also required. If we acquire the competitor or supplier, then we need to think because we need to pay them. Okay, so we need to infuse the capital. So that can be either by way of equity or loan. Equity or loan. So this way, all this scenario, okay, affect my pro forma financial statement. Okay. Okay. So this is, and then accordingly we need to prepare the short-term objectives. I mean this year. Okay, so these are even though the long-term. I mean some of them are long-term. So what will be the impact of this strategy in a short term? Because we are preparing the financial plan or the business plan for 1 year. Say for I'm going to acquire the supplier. Okay, but it requires the 3 years time. 3 years time. So I need to calculate what would be the impact on in a first year only if I'm preparing the first year plan. Okay, so impact on first year only. Okay. So after we calculate the short-term objectives, means whatever may be my mission and strategy, how it impact to my short-term objective. Okay, and accordingly I need to calculate my sales budget. So if you see, we start all the operational planning from the sales budget, and in parallel there is a capital budget because if I want to go for, so this is basically, so this is basically the parallelly we are doing. So I mean the sales budget I'm going to calculate, okay, so I can prepare my operation plan. But to achieve my operation plan, if I need to increase the capacity, okay, so then I need to go for a capital budget. So it is we start from the sales budget, then we prepare the production budget. On that basis, we whatever may be the operate cost we required for the conversion or the operation that we prepare, and parallelly we are preparing the sales, selling and administrative expenses. Okay, and once I prepare like direct material, direct labor, and the factory overhead, which will give me the budget for my cost of goods sold and selling and admin expenses plus capex, then I am in position to prepare my cash budget and the pro forma financial statement. Okay, so we start now first for the operating budget. So as we already discussed, then the sales budget, then selling and administrative expenses in one hand, and then the production budget in other hand. Then we need to calculate the material budget, labor budget, and the factory overhead budget, and the cost of goods sold. Okay, so sales budget, how we are going to calculate? So it is basically the past pattern of the cell. So if I'm in the, say for like saturated level, that means only I'm able to get the organic growth. Okay, so in that situation, I assume every year on year basis, I may increase the 20% sales. Okay, or whatever may be the past pattern. Say for in 2021, the sale is 100, 2022, it is 120. So 2023. So it is basically 144 like this. Okay, so it will give the growth of 20% on year to year basis. Okay, so same I can follow for the 2024 and 2025 like this. Okay, so it is basically the 20% I'm expecting the growth. Then estimate. Okay, so there are also an issue. Okay, so Salesforce is so Salesforce estimate for the calculation of the sales budget is mainly means like if I calculate my per employee basis sales, okay, and if I'm adding the more sales, so generally we need to calculate for the trading items or whenever we operate in a perfect competition. If I increase my sales force, then there is a scope of additional sales. Okay, so this way I need to consider. Then general economic conditions, I mean, if the economy is in a booming situation or there may be a recession, okay, so accordingly we need to evaluate, okay, and then we need to make an adjustment for the sales. I mean, whatever the sales we did in the past year, and now whatever the sales we need to do, okay, so that also we need, while calculation, we need to see what would be the economic condition. Competitors action, okay, so if competitor is not going to make an advertisement or he is not basically promoting his product, that means there may be a chances of discontinuation of the product. So this may affect in a two way, either our sales may increase or also we need to think whether the product may get discontinued or it is not accepted by the customer. So accordingly we need to make an adjustment. Then changes in the firm prices. Okay, so firm prices like sometime what happened, I'm selling one product, okay, because of any issue, like say for the machine breakdown or raw material prices, sudden increase in raw material prices. Okay, so if I sell this product on at a market price, so it is lost to me. It is lost to me. So in that situation, what I'm doing, I'm trying to like divert whatever may be the resources to other product, to other product. So to other products. So in that situation, the sale of particular product may down, say for the product X, okay, it is down, but parallelly the product Y may increase. So we need to make this kind of adjustment because of the firm prices. Okay, then changes in product mix, the same what we discussed just now. Okay, so sometime the acceptance for a particular product means if I'm selling, general ratio is basically I'm three product A, B, and C. When I'm selling the 10 product of A, it may possible the two product of B may go and the one product of C may go. But now when I'm selling a five product of A, so it is basically the B may go two product and C may go one product. Okay, so that is basically the change in product mix. So depend on the consumer test. Okay, we need to decide it. Then the result of market research study. So whenever we are making any sales plan, we need to evaluate what would be my what could be the what could be like the sales I'm going to achieve on the basis of market reaction. and advertising and sales promotion. So always the sales may boost because of the sales promotion activities or the advertising activities. So sometimes what happened, we are I mean like if we buy the one product, then we may offer the 100 rupees, but if you buy the three product, then we may give the 10% discount. Okay, and because of that reason, like 270, it is like this. So because of that reason, most of the consumer may buy three product at a time. Okay, so that also we need to evaluate. Okay, or there may be an advertising, or there may be a free on purchase of the 5 quantity, there may be the one free quantity. Okay, so these are basically the aspect which we need to consider while deciding the sales plan. Then there is a certain activities, like we are giving a coupon which they can redeem maybe in the future purchases. Okay, so that also we need to factor. So whatever may be the factor basically which influence your sales quantity, that all we need to consider. Okay. Now, I mean, so we just need to take one example. So here, I mean, how we are creating the sales budget. Sales budget is particularly the estimate which we can do, estimate which basically we can do, which we can estimate, which we can do while finalizing the number for the next year. Okay, so Blindfold Stereo is a retailer of the audio equipment. So Blindfold sales manager is working with the controller to develop the sales budget for the next year. So Blindfold's sales manager knows that the sales volume is a seasonal and that it can be influenced by the price and the promotion. So sales manager has developed the following sale forecast based on the unit to be sold and the average selling price. So assumption, first quarter sales are often weak. The sales manager project the following sales volume for aggregate unit and the average prices. So 2000 unit at a full retail price of the $75 quantity unit. So it is 2000 unit at $75 unit price. Then 2500 unit assuming discount down to $60. 60. So second quarter sales strengthen somewhat for graduation and the Father's Day promotion. A greater volume and ability to collect the full retail can be anticipated based on the promotion. So again, 3000 unit at 75 and the 4000 unit at 60. Then third quarter, it is again 1500 and 200, 500 and 2000, sorry. So which is 75 and 50. And then 7000 unit, fourth quarter, 7000 at 75 and 10,000 at 60. Okay, and then we need to total. Total. Okay, so required to forecast, develop, sell budget, assuming that the company has selected cost leadership strategy. So here basically average price 60, 60, 60, 10 lakh 90,000. Quarter one. Okay, so cost leadership 60. For the aggregate unit and the average prices. Okay. Okay, so we took, okay, so it is not basically the, okay, so this way also we can calculate, means if we come to know, but this is not the total volume. This is basically like, this is basically the either or the situation they gave. Yeah, 10 lakh 90,000 because of that reason. Okay. 90,000, 10 lakh 12,500. Okay. So here, basically, I mean, if I consider at this prices, then we may get a 10 lakh 90,000. And if I consider this prices, then we may get a 10 lakh 12,500. Okay. So with respect to, I mean, considering the production, this is again the management call basically, okay, whether we need to go with this. Okay. Okay, tell me something, because see, if we are considering the target costing, means here the word they gave, cost leadership strategy. Okay, so cost leadership strategy means they want to minimize, maintain the minimum prices. So that's why they decided to make a forecast with the 60, 60, 50, 60, means the lowest prices, not the highest prices. Okay, but if you are with the profit oriented, okay, you want to, what would be the situation where instead of preparing a budget for 18,500, okay, you will like to go with the producing the quantity 13,500. Anyone, I mean, just consider the hypothetical example. See, I have a two scenarios. Okay, so where in a one scenario, if I produce sell 18,500, I may get the revenue of 10 lakh 90,000, and in the other scenario, 13,500, I may go with the revenue of 10 lakh 12,500. Okay, so in this example, it is given that we are going to adopt the cost leadership strategy. In a cost leadership strategy, we generally sell our product at the lowest prices. Okay, so that's why we may decided to go with this plan 18,500, 10 lakh 90,000. Okay, but I mean, always you are going to go with this plan, or you may think, no, no, I want to go with the 13,500 with the revenue of 10 lakh 12,500. Okay, and if you want to go with this, what would be your strategy? Anyone can guess or can think over it? See, because it is given in the question that we are following the cost leadership strategy, that's why we need to decide it, go with the lower prices. But like this is the only way out, or this is the only criteria where we need to prepare a sales budget, or instead of going 18,500, can I go for a 13,500? And if yes, what would be the logic? Or if I produce 18, if I sell 18,500, okay, with 10 lakh 90,000, okay, and if I sell 13,500, I may get the revenue of 10 lakh 12,500. What would be the difference? Why I'm going to select as a 13,500? Sorry, as a sales budget. See, we should not calculate the only numbers. Why we are calculating the numbers, that we should know. Any guess from anyone's side?
Sir, is it because we're getting more revenue for the less cost?
Yeah, absolutely right. So sometime what happened, if the unit facing a scarcity of finance, Okay, scarcity of the finance means what happened if they want to produce more by taking an external finance like loan. So they can think finance, then they can think whether they need to go with this, I mean the cost leadership strategy or the premium. Okay, so if I'm getting a premium, okay, with a or I'm able to earn the higher margin, okay, with a low production cost, lower production cost, that means my investment is less. Okay, so in that situation, I may go with this strategy. Okay, then I mean there are so many other factors. Sometimes what happened if you see like my financial year is January to December. Okay, if I consider this is my financial year. Okay, most of the companies, particularly like capital project. Okay, so they raise the purchase order PO. Okay, beginning of the year. Okay, and get the material or not material, equipment, capital equipment in second half of the year. Okay, so supplier of this kind of equipment, if they want to plan their budget, okay, supplier, okay, so how they are going to plan their sales may be Jan to June, say for one, and July to December, it is two times. Okay, so they need to prepare their budget. They need to prepare their budget. In the first half, they have a less sell, and in the second half, they have a higher sell. Okay, so what happened if some customer want a delivery in this period? Means, this is the normal trend, but there may be an exception. Okay, so because they don't have a much work on this period, means some customer may say there is a purchase order in the month of October to sorry, not yeah, October to December. Okay, and they want the delivery by June. Okay, so they can quote a lesser price because at that time anyhow like the supply, I mean the company don't have a much work. So if their customer gave a PO in the month of October to December instead of first half January to June, okay, and expected delivery in the June, okay, so then they need to quote a lesser price. So that adjustment also they need to make. Means this portion may for this portion they may get the higher price volume, okay, and for this portion they may get the lower price. Okay, so how we are calculating the sales budget? Say for my total expectation is 300 crore. Okay, now like in the first 100 crore, say for it is 80% prices. Okay, and the next 200 crore, it is basically the 110% prices. Okay, so so what happened in the first half? I'll consider this 80%, 80, and in the second half, I'm consider this, and this way I'm preparing my budget. So like this, I need to manage my working capital. Okay, so first half I'm expecting the 80 as my total turnover, and in the second half I'm expecting 220, which if I add, then it is 300. So this way I need to make a budget. So this is basically the first half, and this is second half. And this way we need to do the
Sir,
sales plan. Yeah.
sir, so the 80 and 220 is the price which you're setting
See, if I go
to
with the,
sell.
yeah, so if I go with the standard price, okay, so this is, okay, now I need to create my equation. Okay. Like in a first year, 80%, means I can procure or I can dispatch my standard machine at a 80% price. So even though these are my standard price, I may get the sales volume of 80. And in the second half, I can charge the premium to customer. So even though as per my standard price it is 200, then I can maintain it as at 220. And this way we are going to build the volume of 300 crore.
Okay, sir.
Okay, and accordingly, means all the numbers related to the profitability get changed. So this way we do the planning. Means we need to consider several factors while compiling my sales budget. Okay, so this way also we need to do. Then once I finalize the sales budget, then we need to make a like production budget, and parallelly we can do the selling and administrative expenses budget. So if I continue this example in a first half, okay, first half my profitability is less, okay, but purchasing and manpower requirement is also less, okay. So we are going to means as per the production budget. So production planning, how we are going to do? See, I want to make a sales, means I'm taking a number instead of quantity amount. Okay, so 300 crore is my sales. Okay, plus I want to build the inventory for upcoming year, which may be the 50 crore. Change in inventory, it is plus. If it is plus, what does it mean? My next year sales target would be higher. Okay. So what is my production number? It is 350 crore. So now I need to produce 350 crore. So accordingly, we need to calculate the requirement of the raw material. We need to calculate the requirement of the labor, direct labor, and what would be my production overhead, both variable and fixed. Okay, so accordingly, direct material, direct labor, and the factory overhead. So production budget. I hope you are able to understand. It is basically whatever the sales we are doing. Okay, and plus minus or the adjustment of the change in inventory. So you can see here. So like plus desired in the inventory in beginning, minus beginning inventory means change in inventory. So whatever may be the my budgeted sell. Okay, always we need to add the closing inventory. So that's why the desired ending inventory, that we need to add and reduce closing inventory. Sorry, beginning inventory. So keep in mind, always sales is associated with the closing inventory. If you see, means whenever you are calculating the preparing the trading account, okay. So sales and the closing inventory is in credit side, credit side. So that means sales and closing inventory we need to add, okay. And the opening inventory is in debit side, so that we need to reduce. So that logic you need to keep in mind. So we can see. So Carly's Manufacturing is trying to estimate the level of production for the month of June. Assume that the Carly's wants safety stock in the beginning inventory of 30% of the estimated sales, and that estimated sales for the June and July are 40,000 and 30,000. Okay, so if I consider this, June, these are basically the estimated sale. So it is 40,000 and the July 30,000. Okay, so this sales is given. So we need to calculate the production for the month of June. Okay, so like again, opening inventory means I'm just writing the formula plus production. This number we need to calculate, that always equal to sales and the closing inventory. This is plus. So sales in the month of June, it is given 40,000. Okay. So if the sales is 40,000 and as it is given the for 30% safety stock we kept as per the estimated sale and for the month of estimated sale. Okay. So for June it is 40,000. That means the opening inventory is 12,000. Okay. 30% of June sale. Okay, and the July sale is 30,000. Okay, so closing inventory is 9,000. So where here the change in inventory is a positive or negative? Opening inventory is 12,000, closing inventory is 9,000. So what is my change in inventory? So, and it is positive or negative? Sorry? Negative, correct. Because the closing inventory is less, so that's why we need to consider the change in inventory is negative. So it is total is 49,000. 49,000 minus 12,000. So it is 37,000 would be my production number. Okay. So if change in inventory is negative, that means the production number is less than sales number. Let's see. Yeah, 37,000 is my production. Okay. So if the 37,000 is my production, then I need to plan raw material requirement for producing 37,000, direct labor requirement for producing 37,000 and the production overhead. So this way we need to calculate the production requirement, means from sales budget to the production. Okay. So it is always the production is basically the sales plus minus change in inventory. Other factors affecting the production budget, company policies regarding the stable production. Okay, so even though, but actually, I mean, before it applies to the production, it always applies to the sales. Okay, condition of production equipment. Okay, so what happened? I mean, that also we need to consider. Okay, okay, from market I can get the sale projection of 300 crore, but I need to evaluate can my current resources accommodate that sales budget. Okay, if my current resources are not able to accommodate, so what is additional way out for me, or the management want to go on a conservative basis. Okay, why they want to, they mostly go on a conservative basis because sometime what happened in a market, we may get an additional volume or the additional orders. Okay, this is for a short term period, I mean for 1 or 2 years, and for that we cannot build the factory or we cannot develop the supplier. Okay, because the cost of developing the supplier means even if I plan to outsource, okay, that may be high as compared to the profit which we may generate with the additional orders. So that's why sometimes the management may decide, okay, we need to see the growth rate in a market for 1 or 2 year, and then we decide whether we need to develop additional supplier or whether we need to go for an expansion. Then availability of the productive resources, because even though I'm getting an order, but if I'm not able to get the sufficient manpower or the skilled manpower, so in that situation I cannot complete the orders in time. So that also we need to see. Then experience with the production yield and the quality, means like my particular machine, if I give a additional load, then the quality may get disturbed. So on the basis of the past experience also, we need to evaluate whether we need to go for a higher production budget or not. Means what happened from sales, this is the change in inventory, less I mean the decrease in production. But otherwise, if I'm expecting a sale of 50,000 quantity and plus 5,000 additional buffer I need to create. So I need to produce the 50,000, 55,000 quantity. But my current setup has a capacity to build the 45,000. So in that situation, I first cut down from the the safety stock, okay, that I can reduce it, but still I cannot match the current demand, so I need to revise my demand to the 45,000, and accordingly I'm finalizing my sales budget. So sometime mostly sales budget drive the other component of the budget, but sometime it is fall back and we need to revise the sales budget as well. Then direct material budget. So it is basically means if I decide to produce 37,000 quantity, means in this example, then whatever may be the raw material required to produce 37,000 quantity, that we need to evaluate. So that is basically the direct material budget. So it is again, there is also the change in inventory. Means like I have a safety stock of raw material, say for 10,000 quantity opening, and raw material 20,000 for next month production. Next month production. Okay. And for if I decide to produce the 40,000 quantity for that finished product, finished good, for that I need the raw material of say for 120,000 quantity. Okay. So how much I need to purchase? Okay, this production I need to do. I need to do in a 1 month time. For that I need a 1,20,000. Then my opening raw material is 10,000, and the closing raw material I want to keep 20,000. Okay, so this is my production. How much I need to purchase? So here formula is basically opening raw material plus purchases. You can imagine the trading account. Okay, and then the production is basically means when I'm shift production to the sale, that means it is out. Okay, and the closing raw material. Okay, so in this situation production is 120,000, means the raw material required for production of 40,000 quantity. For production of 40,000 quantity. Okay, closing raw material is 20,000, opening raw material is 10,000. So how much I need to purchase? 130,000. Okay, so this way I need to calculate what is my desired purchases or direct material purchase budget. Okay, on the basis of production, I am calculating how much material I need to purchase. So number of unit to be purchased. So unit of direct material needed for the production, like this one, plus closing, this one, and the minus opening, this one. So unit of direct material needed for a production period plus desired ending inventory at the end of the period and minus beginning inventory at the end of the period. So divide by unit of direct material to be purchased for the period. So this way we need to calculate. So cost of direct material purchase. Okay. So here, because we are preparing the budget, so how much I need to purchase? It is 130,000, correct? Not 20,000. 120,000 is my requirement for the production, but I want to maintain the additional raw material. So that's why 130,000. And the per unit price, say for 10, okay. So total is basically my purchase budget is 13 lakh. Like this. This is my purchase budget. Direct material usage budget. Okay, so direct material usage, cost of material use. Okay, so it is again beginning inventory, purchase at cost. So this is basically the material required for the production usage budget. So budget, that is the quantity required for production for output multiplied by price. Okay, or you can calculate like beginning inventory, it is okay at cost, the cost may be the different. Okay, why cost may be the different? Sometimes the opening inventory is cost at a weighted average cost method, and that cost may be not as per the current purchase cost. Okay, so that cost may be the different. Okay, so you can just take an example, not 10, it may be the, instead of 10 lakh, I'm keeping 12 lakh. Once we purchase at higher rate, okay, we need to purchase 13 lakh, not 1 lakh 20,000, 10,000 quantity, 13 lakh, and the ending inventory, maybe it is at the same price, 20,000. Okay, so it is 2 lakh. So what is my production of the raw material, cost of raw material? So it is 13 plus beginning invent plus purchases. So it is 14 lakh 20,000, 12 lakh 20,000. That is my direct material uses. So this amount goes to cost of production or cost of goods sold. Okay, and then plus conversion cost. Okay, so cost of goods sold, not cost of material consumed. Cost consumed. This is my box. Cost of goods sold. Material cost consumed plus conversion cost, that is my total cost, cost of goods sold. Then direct labor hour. So whatever may be the budgeted production in unit. So we already discussed, say for 40,000 quantity I need to produce. Okay, 1,20,000 is the requirement of the raw material, but the final production is basically the 40,000 unit. Okay, and for that whatever the hours we required. Okay, so per unit maybe the 2 hour required, so my requirement is 80,000. Okay, and then multiplied by wage hour rate, so it is say for 20 per hour, so it is 1,60,000. 1,60,000. That is basically the total wage. Okay, so here while calculating the raw material, you need to, means if it is a bulk quantity then it is okay, otherwise if it is a partial produce, means if there is a WIP, okay, so you need to calculate, say for 1,000 quantity you already completed 60% task. So how much you are going to complete? The 40%. Okay, per quantity you required the 2 hours, so I'm consider not 40,000. Yeah, so I'm consider here the 5,000 as a, so 60% completed, 40% remaining. So per hour it is required 2 hour. Okay, so 40% of 5,000 quantity. So how much I need to consider here? 2,000. Okay, then I want to produce the full quantity, means introduce this year and the completed this year, which is basically the 36,000, not 35,000. Okay, so this is basically my total production. So it is, because the 5,000 plus 35, this is my total 40,000. Out of this 2,000 is process like in current period. Okay, so I may require to pay for a 37,000. So per hour is 2. So it is 54, 64, 74,000, and then multiplied by my wage rate. One lakh 48,000. Okay. See what happened again. Like I want to, I mean, there is no closing inventory. Otherwise, that also we need to make an adjustment. Okay. So say for I want to produce the 40,000 quantity. Out of this, the 5,000 I'm getting as an WIP from previous period, on which 60% work I'm already completed. So how much work I need to do? 40%. So that's why I consider the weighted average 2,000 quantity against 5,000. Okay, the 35,000 introduced this period and the completed both. Okay, so total estimated, I mean the weighted average is basically 37,000 quantity which we need to produce. Okay, per quantity I need a 2 hour, so I need direct labor hour 74,000, and I assume here there is no closing inventory. Okay, so that's why otherwise it is increased further. Okay, and the 20 is per hour labor. Okay, if I multiply, then 148,000 is my labor costs. Labor cost. Okay, so this way I need to prepare this budget. Whenever we have solved the example, at that time we see in more detail, but try to understand the concept. I mean, if I maintain the closing inventory, say for here the 5,000, 35,000, and I want to maintain the 10,000 as a closing inventory, which is 20% completed. Okay, so then how I am calculating my requirement? 2,000 I need to complete this period. Okay, because I need to finish 40,000. 35,000 I am doing full pledgedly. Okay, and that 20% of the 10,000 I completed, so it is again 2,000. Okay, so total production is 37 plus 2, 39,000. Per hour is 2 direct labor requirement. Direct labor hour requirement. Okay, so my 39,000 multiplied by 2 is my direct labor hour requirement, which is 78,000, and then multiplied by 20 is my labor hour rate. So it is 156. So it is 15 lakh 60,000 is my labor hour cost. Okay. Out of this, like 2,000 multiplied by 20, like 40,000. This is the part of WIP, and 1,48,000. It is 14,80,000 actually. 14,80,000. Okay, this is my part of COGS. Means particularly related to the 37,000. Or there may be some calculation error. Okay, but and the 2,000 R, which is related to the closing stock or closing WIP. Okay, this is basically the part of the total monthly cost is my 15,60,000, which I need to divide for 37,000 and 2,000. This is the part of cost of goods sold, and this is the part of closing inventory or work in progress. Clear? If any point you are not able to understand, please raise the voice. Okay, we'll see one example. So again, the same example. So Carsley Manufacturing computed its budgeted production at 30,000 unit to sustain the budgeted sale of 40,000 unit. Means they need to produce 37,000, which we calculate in the month of June. 4 pound of direct material for 37,000 quantity. This is my production quantity. Produce. Okay. I need the direct material, which is 4 pound for each unit, and the direct labor, which is okay, cost is 10 per pound, and then acquired and they were previously acquired for 9 per pound. Okay. I have 48 hand at the beginning of the June. Okay. So here direct material, direct labor is also given. Okay. So first I'll calculate the direct material only. So this is the current scenario. And then they have a 9 per pound for the opening stock. Okay. So 48,000 is basically there at the beginning and has desired material ending is okay. 48,000 multiplied by 9, that is my opening stock. Okay. And the 36,000 is my closing inventory. Okay. So that is mostly with the 10, the current cost. Okay. This is my closing inventory. Closing stock. Okay. Hope you are able to understand this question. 48,000 is my opening, which I purchased with the $9 per pound, and 36,000 pound is my closing inventory, which I need to purchase. I mean, this is basically the part of current purchase price. Okay. My requirement is now you can consider the 48,000 opening stock. Okay. Purchase I want to calculate. Production, I mean the material required for the production I am aware, which is basically 37,000 multiplied by 4. Okay, so it is 37 multiplied by 4. How much? Okay, sorry, here. Okay, and the closing stock is 36,000. Okay, so 148 plus 36 minus 48. Okay, so that we need to that is my purchase. So it is basically, if you see, the opening is 48, closing is 36. So my change in inventory is minus 12,000. So I can easily calculate like 14 lakh 1 lakh 48,000 minus 12,000. So it is 1 lakh 36,000. Okay, so this is basically the quantity. Okay, this is my closing stock. Okay, now we need to calculate like what expenses we need to incur, because they gave the I mean the unit of direct material needed for the production period, budgeted production. Okay, so I'll just calculate the value as well. Okay, so 48,000 multiplied by 9, which is 430,000 opening stock. Then purchases is basically 136,000 multiplied by 10. Okay, and the closing stock is, again we need to evaluate with the current prices 10. So what is my production cost? This plus this minus this. Okay, again 14 lakh 32. This is opening stock, closing stock at value. This is my purchase. Okay, so we need to derive cost of material consumed. Okay, so this basically become the part of cost of goods sold. Okay, let's see. 37,000, 148,000 multiplied by 4. So 148,000 is my requirement. 36,000 pound is basically the opening direct material. Ending inventory, sorry, 48,000 is opening. Okay, so sorry, closing inventory, and the direct material to be purchased 136,000. Yeah, correct. Okay, if you see 136,000 is purchased, yeah, and which we need to calculate with the value of 10. So direct material purchase is 13 lakh 60,000, and then direct material usage, beginning inventory 48,000 multiplied by 9, so it is 4 lakh 32,000. Purchase cost is 30 lakh 60,000, and the 3 lakh 60,000 is my closing. So my material usage is 14 lakh 32,000. Yeah. Okay. So this way we need to calculate that. This number will become your part of the production budget. Okay. Then we need to think direct labor. What is given? So 2 hours of direct labor at 20 per hour are needed to convert the direct material, prepare the direct material and direct labor for that. So here they have not given any WIP. So it is assumed we whatever the material introduced that we converted fully in the current period. So if I consider this, so 37,000 is my production. Okay, multiplied by uh, 2 hours. This is my requirement. So it is 74,000. Okay, that is my direct labor hour. Okay, hour. This is hour, direct labor hour. So price is or the direct labor cost 4,000 multiplied by 20. So it is 0, 1, 2, 3, 4 and 8, 14 lakh 80,000. This is my direct labor cost. 2 and 14 lakh 80,000. Okay. As I already informed, if there is a opening WIP and closing WIP is given, then you need to make an adjustment for it as well. Okay. Here there is no opening and WIP given. That means entire entire conversion, okay, which we need to do in a current period. So 100% whatever the 37,000 we produce, okay, that is produced in current period, okay, and each unit we need a 2 hour for each unit of production. So that's why total hour require 74,000 and the per hour rate is $20. So it is 14 lakh 80,000 is my direct labor cost or the direct labor. Okay, so factory overhead budget. So that we start after the 15-minute break. Okay, so we gather then 840. Okay,
Okay, sir.
Okay, so I hope I'm audible properly. Okay, so any doubt till now, whatever we discuss? So you will get almost 5 to 6 questions on all this topic, and you need to solve. I mean, of course, whenever we are going to take a practical questions, at that time also you may get a more clarity. Okay, so factory overhead budget. See what happened. Okay, direct material and direct labor are variable cost. Okay, so we can link up with sales or volume. Sales or volume, sorry, sales or production. Okay, but factory overhead, basically the fixed component, okay, fixed component that we cannot link up. Okay, that I need to maintain the same, even though whatever may be my sales volume or the production volume cannot change with respect to sales or production volume. But the variable component is basically that again the same way. I mean the way we are driving the direct material and direct labor. Okay, so factory overhead, that is include the fixed and variable cost. Okay, that are not direct labor or the direct material. So factory overhead is applied into inventory cost of goods manufactured and the sold below based on the representative statistic. So it is basically the cost driver. Okay, one more issue. Generally in P&L or in the balance sheet, like for cost of goods sold and the inventory. Okay, so we apply the factory overhead rate. Apply factory overhead rate. Okay, so it is basically the standard rate which we calculate. Okay, and whatever may be the variation, okay, variation amongst the actual minus standard. Standard, whatever may be the whether plus or minus, that is considered as a period cost. Period cost that you need to keep in mind. Okay, so for example, like if I recover the factory overhead on a direct labor, okay. So for 37,000 quantity, we need a 74,000 direct labor hour, okay. And I assume the standard recovery of factory overhead. Factory overhead is basically at the rate of $1 per labor hour. So 74,000 multiplied by 1. This is my factory overhead cost. Is my factory overhead cost. Okay. And if the actual expenses is 75,000, so that difference 1,000 is considered as a period cost. Period cost. Okay. My first question, are you able to understand what is basically the standard recovery rate? If not, then I'll explain in a detail. Anyone has any idea? I mean, any doubt or confusion? See, okay, what happened? I created the budget and I decided my production overhead is say for 75,000. Okay, and the expected R is also the 75,000. So $1 is basically the standard recovery R. Okay, or consider the 74,000. Okay, this is my standard. Okay, but while making an
Sir,
yes,
sir, you're not audible.
hello, no one is able to listen me or what? Hello.
I think sir not joined yet.
Tanisha, means I think my mic and everything is okay. Okay, understood. Just a minute. And am I audible now? Hello. Now? Hello.
Yes, sir. Yes, sir.
Yes, sir. Yes,
Okay,
sir.
okay.
Yes.
Now it is done. Thank you. Okay, I'll start again with the factory production overhead. Yeah. Okay. So factory over production overhead. Okay. So this is basically we are not like deal like this like we deal with the direct material and direct labor. Okay. Factory production overhead means there is a fixed component and there is a variable component. Variable component you can deal like direct material and direct labor, but the fixed component is basically you cannot change, okay, with respect to sales or production volume. Okay, direct material, direct labor always link up with sales or production volume. volume, but the factory overhead we cannot link up with the sales or production volume. Second issue, like fix, means we need to charge factory overhead cost to product on the basis of standard rate. Okay. Say for if I'm charging on a direct labor hour and my standard recovery rate is $1. Okay. So whatever may be the direct labor hour use, okay, I can recover at $1 per hour. Okay, so that you need to understand. See how, I means direct labor. Okay, I am aware how much labor they use. What is my what is my actual labor hour rate paid? Okay, I can make an I means I can decide what is my expenses. Okay, but in case of the factory overhead, that we need to recover on the basis of predetermined rate. Okay, and that we need to consider as a cost of the production. Okay, so like in earlier question, 37,000 is my production. For that, 74,000 are required. Okay, and this 74,000 are, means in this question, like $5 is basically the per hour recovery rate, means which I consider this $1 as a standard rate. Okay, so $5 is my per hour recovery rate. Okay, so my factory overhead cost for that year is 74,000 multiplied by 5. Okay, which is 3,70,000. Yeah. Okay, so this is my cost. Okay, I'm just giving one example. See, in like whenever I gave a change in WIP, so here if you recollect, the 60% work completed for 5,000 quantity. So balance 40% we need to do. So 2,000 quantity I need to consider. Okay, and 35,000 because I need to 40,000 is my sell. Okay, so 35,000 I need to introduce this year and completed this year 35,000 and plus 10,000 quantity, which is 20% completed, so it is 2,000. So if you recollect this example, so 39,000 is basically my total labor hour use, or total weighted average production, not total weighted average production. Okay, and then this 39,000, okay, we need to bifurcate 2,000 as a WIP, this one, and the 37,000 is my current year cost, current production. Okay, and then the per direct labor hour is 2, so it is 4,000 and 74,000. Okay, and then my production overhead, like it is the standard is first, so like 20,000 and this 3,70,000. Okay, so if you see my total expenses, if the total expenses of a factory overhead is 3,90,000, but we need to consider this as my cost of goods sold and this as my WIP, closing WIP. Okay, so this way we need to do. Are you able to understand? Okay, and the plus whatever may be the opening WIP, that is separate. Okay, so this is also the means opening WIP plus this, that is my total cost of goods sold. Okay, are you able to understand this example? I am able to explain properly or not? Anyone has any doubt here? So see, whatever the illustration given or the example given in a Becker material, that is quite simple. Means whatever may be the production, that is entirely is my sales. Okay. There is no WIP given in this question, but of course, in while doing a practice, we will take some example of like that. Okay, so whenever you are manufacturing something, it is not necessary the product get 100% completed. So you always need to calculate how much value addition you did in a current year. Okay, and accordingly you need to give the treatment. Okay, opening WIP, once it is completed, it is a part of cost of goods sold or cost of goods manufactured. That's why we need to consider as a PNL item, and the closing WIP, it is still remain in my balance sheet. This is not the part of my cost of goods manufactured. So that's why we need to keep separately. 37,000 is basically, if you see, 2,000 which is opening plus introduce and produce. Introduce and completed, I can say 35,000. So these are my part of the current year cost of goods manufactured, COGM. Okay, and this 2,000 I have not completed 100%. Not completed. Okay, so that you need to keep in mind. Now, cost of goods manufactured. So here you can consider. So here cost of goods manufactured is whatever may be the direct labor hour, current year, direct material, and the direct factory overhead. Whatever may be the factory overhead. It is all direct, indirect. Okay. So component of cost of goods sold, direct labor, direct material, and the factory overhead. So cost of goods sold, consider cost of goods manufactured in relation to the beginning and ending inventory of the finished good as follows. So you need to consider cost of goods sold manufactured plus beginning finished good inventory and minus ending inventory. So just keep in mind, only in this formula, the finish beginning inventory get added. Okay, and then we need to find out the cost of goods sold, and the ending finished goods inventory get deducted. Okay, okay. Earlier both the formula, the closing stock get added. Okay, so what we calculate, first produce, then raw material purchases, and then COGM, cost of goods manufactured. Okay, you can see the formula. Like while doing the production, we start from opening stock. Means I always start from the opening stock, add production that we are going to calculate. Add, okay, and the less sales quantity which we aware, and the closing stock. Okay, which will give the numbers. Okay, so this plus this minus this is this one. Okay, so this is plus, and this is minus. So what happened? Sales and closing stock we are add together, and we deduct the opening inventory. So I will get the production. The same way purchases, opening stock, we need to calculate the purchase. Okay, so then this is basically the add, and then there is a less, which is basically a production, and the less closing inventory. So here also we need to calculate the purchase. So that's why this add, this minus. Okay, so opening stock is again get deducted. Okay, so you will get the production, closing stock that you need to add together, and the opening stock and purchases. Okay, so now you are calculating the cost of goods manufactured. Okay, so here again opening FG plus production. Okay, and then this basically the cost of goods manufactured and the closing stock, closing FG. Okay, so here what happened, you are calculating this one, not above the line. Okay, so that's why this is get deduct this plus. Okay, this way you need to memorize the formula. Okay. So while calculating, I mean, generally you need to calculate the raw material purchases, cost of goods manufactured, and the production quantity. Okay. Opening inventory, closing inventory, and opening, closing, it is all given. 90% cases, in 10% cases, you may calculate the opening or closing. Okay. But generally this information you need to calculate. So while calculation of the production or the raw material purchases, you need to add the closing inventory and deduct the opening inventory. But while calculating the cost of goods manufactured, you need to deduct the closing inventory and add the opening inventory. That you need to keep in mind. So this way we need to calculate. First we calculate the production, then raw material purchases, and then cost of goods manufactured, or the cost of goods, cost of goods sold. Sorry, cost of goods sold. Cost of goods manufactured is basically the raw material consumption. It is the plus of raw material usage cost plus direct labor hour use cost and plus factory overhead applied. Okay, so that you need to add. This is your total cost of goods manufactured. Okay. So, so from cost of goods manufactured, you need to bifurcate basically the inventory and the cost of goods sold. So we can see the example. So Carlisle Manufacturing is preparing a budgeted cost of goods manufactured and budgeted cost of goods sold schedule for the month of June. It is developed the following information: direct material goods, direct material use, direct labor use, and the factory overhead variable. Okay, factory overhead fixed, it is given, and the finished goods and ending, finished goods beginning and the finished goods ending, it is also given. So calculate the cost of goods manufactured. So direct material use they gave, so we do not require to calculate the raw material purchases. Okay. So first 4 line item that will give the cost of goods manufactured. COGM is basically direct material use, which is 14,32,000. Direct labor, which is 14,80,000. Then factory overhead variable, it is also 3 lakh, how much? 13 lakh, 3,70,000. And then factory overhead fix. This is also 3 lakh, it is given. Okay. If I add all this, then I will get the cost of goods manufactured. Okay. I want to calculate the cost of goods sold. Okay. First I'll add this. Okay. Which is 35 lakh 82,000. And then we need to add opening stock, because it is assume opening stock first dispatch. Okay, we are calculating the cost of goods sold. So it is that we need to add 10 lakh, and then we need to deduct closing stock. Okay, whatever may be the expenses we incurred for the building the closing stock, that we need to capitalize. That is not the part of P&L. Okay, stock. So it is minus 7,50,000. Okay, so total cost of goods sold is basically 35,82,000 plus 10 lakh minus 7,50,000, which is 38,32,000. So that is my cost of goods sold. Let's see. So it is 35 lakh plus 10 lakh. So 38 lakh 32,000 is my cost of goods sold. Okay. Okay. So are you able to understand? Means production, purchase of raw material, and then whatever may be the usage value. If we add all three component or four component, okay. So then it is basically the cost of goods manufactured, and then you need to decide how much portion we need to divert to cost of WIP and how much portion we need to divert to cost of good sold. Okay. So that you can decide on the basis of opening and closing stock. And then cost of goods sold and the pro forma financial statement. So whatever may be the budgeted cost of goods sold amount fits directly into the pro forma income statement. So it is basically like if my sale is say for the 70 lakh, okay, this number you can directly put cost of goods sold, which is 38 lakh 32,000, and this will give me the gross profit GP. So whatever may be the number. So it comes in a financial pro forma financial income statement. Okay. Any doubt till now? Now, selling administrative expenses. So as we already discussed, I mean, whatever may be the component in a prior period that we need to consider as a selling expenses, and then we need to evaluate how much driven by the sales or the production, and how much it is driven by the fixed in nature. Okay. And if there is any indication or if you find any event which may trigger the increase or decrease in expenses, that you need to account for. So variable selling expenses, sales commission, delivery expenses, and the bad debt expenses. So sales commission generally we gave with respect to the sales. Delivery expenses again depend on the number of dispatches. Okay, and the bad debt expenses again depend on the receivable amount or the sales amount. Okay, so that's why it is a variable. Fixed is basically the sales salary, advertising, and depreciation. So sales salaries, whatever the number of people we have in a sales department, this is the one time that I can say variable, but you decide, but it is not the controllable, because once in a year you decide and then you cannot control it. Advertising, generally we do the advertising on the basis of the budget. So that's why we need to consider this as a fix. It is advertising expenses don't have any relation or direct relation on a sale. Okay, and the depreciation. The same way, general and administrative expenses, these are mostly fixed. It is not like driven or affected due to the increase or decrease in the sales volume. So it is administrative salaries, accounting and data processing, depreciation, and other administrative expenses. Selling and administrative expenses and the pro forma financial statement. So generally, see, as I already explained, means if I consider this calculation, sales commission, delivery expenses, okay, and the bad debt. Okay, so this mostly means sales commission I can project. Okay, I mean I decided to do the sales of that volume. Okay, say for 300 crore. Okay, and if I feel the 2% or 1% amount I need to give, so 30 crore, 3 crore is my sales commission. Delivery expenses is generally 1.5% of the sales volume, so I can consider the 4.5 crore. Bad debt is basically the 2%, so it is basically the 6 crore, like this. Okay, so this is all depend on the sales volume. Okay, so this way we need to calculate. Then the fixed selling expenses. So salaries first. So earlier, say for I have a 10 people, and the per person or the cost is basically the for cost is basically the 50 lakh. Okay, and if I feel I want to for taking a growth, I need to add the two people, and I'm giving a average increment of 10%. Okay, so I consider two people I need at a 20 lakh salary total for two people. So for this 50 lakh, I need to add the 5%, 10% increment, which is 5 lakh. So like 55 lakh is my previous year employee cost, and plus additional 20, so it is 75 lakh. So I need to consider in my budget 75 lakh as my salary expenses. Okay, so this way advertising, depreciation, administrative, accounting, data pro depreciation, other administrative expenses that we need to calculate depend on the trend, and if any situation or the event which trigger the additional expenses that we need to consider. Say for administrative expenses is basically the 15% increase on year to year basis. And the last year total administrative cost is say for 15 crore. Okay, so I need to add the 15%, so which is basically 1.5 plus 0.7, so 2.25 crore I need to add. So then my budget is basically the 17.25 crore, like this. Okay, this way we need to prepare the budget. And whatever may be the selling and administrative expenses, like we saw, sales 70, then 38.25 is my COGS. Okay, so my GP is basically 31.75 crore. And with all this calculation, okay, like 17.25 here and then plus 15 crore is basically, I mean, I consider all the factors and everything. So it is basically, or 10 crore I can keep. So it is 27.25 crore. So this is my SGA, which is 27.25 crore. So my net income or EBIT is basically 0.50 and the 4.5 CR, like this. This way we need to do. Clear? So this is my pro forma income statement. Okay. Then financial budget. Okay. Financial budget, cash budget. So cash budget is basically means whatever may be the income statement, the calculation of income we calculated. Okay. Then whatever may be the actual cash available, actual cash, actual receipt we can get, actual disbursement we need to make. Okay. And if there is a shortfall, then how we are going to make out this shortfall. Okay, so by way of increasing the financing. Okay, so that we need to see. Say for I consider my sales is 70 crore, opening debtors 20 crore, and the closing debtors, okay, 18 crore. Okay, so how I am going to calculate my cash receipt? Okay, so it is basically the opening debtors plus sales. Okay, and this supposed to equal to cash receipt and the closing debtors. So opening debtors, what we saw, 20, 70 is sell, so it is total 90, and then 80, 18. So 90 minus 18 is basically the approximately 72 debtors. Okay, so I can consider in my cash flow statement 72 crore. So there are certain other points also we need to consider, like I'm consider here the opening debtors and the sales, but there may be an advance from the customer. Okay, so opening advance from the customer. Okay, so that also we need to factor. Okay, so like opening debtors and sell we need to add. So advance from the customer is exactly opposite. Okay, so here closing advance from the customer I need to add, and the opening advance from the customer I need to deduct. Okay, so this is exactly the opposite. Okay, so if I consider 5 crore opening and the 7 crore is closing. Okay, so now opening debtor is 20, sales is 70, and the closing advance I need to consider this. Okay, so now it become the 97. Okay, this amount we need to calculate the cash receipt. Okay, Now the closing data it is given 18 and the opening data is 5. Okay. So 97 minus 23, that would be my cash receipt. So how much? It is 74 crore. Okay. So here if you see 74 plus 18 plus 5, which is again 97. So I need to consider the 70 crore. Okay. So see, you can evaluate, like earlier you have an advance of 5 crore and the closing level you have an advance of 7 crore. What does it mean? You got the additional 2 crore. So if there is no effect of advances, so your cash collection is 72 crore. Because of your advances, you receive the additional 2 crore in this year. So it is shifted from 70 to 74. So this way we need to calculate. Okay. So that is basically for the cash receipt. Okay. So same way we need to calculate for the payments. So payment again, like opening creditors. Okay. Add purchases. Okay. Remaining is basically then payments or disbursement and closing creditors. Okay. And the same way, like opening creditors, there may be an opening advances to supplier. So I need to add closing advances to the supplier. Exactly reverse. And the here less is basically the opening advances to the supplier. Okay, this way we need to calculate. You will get some amount of the cash reserves. So we can take an example. Opening creditors say for 20 crore, closing advances maybe the 5 crore, and the purchases maybe 40 crore. Okay, so it is basically the 40 plus 20, 60, 65. Okay, cash collection I want to find out. So payment I want to find out. The closing creditors is basically the 10 crore, or I can keep 2 crore. And the opening advances is basically 3 crore. Okay. So what is my cash disbursement? 65 minus 5, 60 crore is my cash disbursement. Okay. So here if you see the cash collection is 74 crore. Cash disbursement is 60 crore. Okay. So there is a 14 crore of cash surplus, right? Or wrong? Anyone has any further comment on it? Are you able to understand how I am going to calculate the cash receipt, cash payment? Okay, so this is basically the cash surplus. Okay, here we are just calculate the customer and the supplier. Okay, but there are certain other like fixed expenses, employee to salary. Okay, so that also we need to consider the plan employee to salary. Okay, other fixed expenses like electricity bill and which we are not paying to the vendor. Okay, so that kind of other operating expenses I consider. Even the government payment like GST, income tax. Okay, so that also we need to consider. So I assume all together this may be my yearly 35 crore, or instead of 35, 34 crore. Okay, so there is a shortfall of 20 crore. 20 crore shortfall. Then you need to decide how you are going to make out. Okay, if you have a previous cash balances, then you can take it from this. Otherwise, you need to see either by way of equity, okay, or by way of the working capital limit. Okay, so that is basically the financing. Is both we need to consider as a financing. Okay. this way. Or if there is any capex, so investment, then we need to further add the capex plan, or that we will discuss, because anyhow we need to discuss separately. Okay, so whatever may be the current shortfall, that we need to consider as a financing. Okay, so cash available, cash disbursement, and the financing. So cash available, basically the cash balances, cash collection, which we already discussed. Okay, now we can see properly an example. So Beacon Inc. is a US retailer creating its cash budget for September. Based on historical data, it assumed that the following information regarding the collection. So 80% of the credit sale collected in the next month after the sale. 18% of the credit sales collected in the second month after the sale, and the remaining is 2%. Okay, and for what period we need to calculate? For September only. Okay, for September. Okay, so in September, if there is a cash sale, that you need to consider as it is. Okay, which is 1,70,000. This is basically the cash element. This is cash. So that you need to consider as it is. Okay. But for others, means if you see 80% collected, percent of credit sale collected in the next month after the sale. Okay. So in September, whatever may be the cash we are getting, that is from the month of August, and the 18% second month. So that is from the month of July. Okay. So July having a sale of 8,50,000, out of 8,50,000, 80,000 we collected in August, and the 80% we collected in the month of August, and the 18% we are going to collected in the month of September. So I'll plot and I'll explain. July, August, and September. I am considering only credit sale. Okay, sale is basically the 8,50,000. August is 9,25,000, and this is 7 lakh. Okay, if I prepare the cash disbursement plan, cash receipt plan, July, August, and September. Okay, so 8,50,000. I am not able to collect anything in the month of July, because the 80% collected in a following month. Okay, 80% I can collect in the month of August. So how much? That I am going to collect in the month of August, and the September I am going to collect 18%, and the 2% may be the bad debt. Okay, so 18%. So I'm going to collect 153,000 from this 8 lakh July sales. Okay, in the month of September. Same for the month of August. Okay, so August sale, there is no question of July collection, because there is no advance. But in the month of August also we cannot collect. But in the month of September, I can collect 80% of August sale. Okay, and the 18% I can collect in the month of October, but here we are calculating only for the September cash. Okay, and there is no collection of the September sale. Okay, but the cash sale is 1,70,000. Okay, so total collection for the month of September is 1,70,000 plus 1,53,000 plus 7,40,000, which is 10,63,000. This is my cash collection. Let's see. 10,63,000. I hope you are able to understand this, means how we are going to calculate. Okay. So means you need to plot this way, and you need to focus for which month you are going to calculate. In examination you may get the 2-3 question on this topic. Okay, so that you need to keep in mind. Okay, and accordingly you need to calculate. Okay, keep in mind like cash collection we need to calculate for that period only. Okay, so sometime in the examination you may not get the separate cash collection. They may say 80% is a credit sale. Okay, total sales they will give, and then they may say 80% is there, 80% is their credit sale. Okay, so accordingly you need to consider. Then cash disbursement. Again, cash disbursement budget represent the cash outlay associated with the purchases and the operating expenses. Okay, so as I said, the salary and other expenses. So sometime in the examination you may get the particular salary which we need to pay in the next month. Okay, or in 10 days or 15 days like this. So accordingly you need to make an adjustment. So cash disbursement budget for the purchase indicate the amount that is expected to be paid for the purchases. So cash disbursement budget include cash purchases for the current period, generally the current month, credit purchases, account payable for the current period, and the cash disbursement required to pay the account payable during the current period. Okay, so in the same way you need to calculate. Okay, so cash disbursement budget are developed using the percentage of goods brought on credit, the age payable liquidated, and the percentage of the good purchases for the cash in the same way, the way we did it. Operating expenses, the same way. Non-cash operating such as depreciation, they eliminate. I mean, the non-cash expenses we are not considering. Okay. Other cash disbursement budget include prior month expenses to be paid in the current month, current month expenses for which disbursement is deferred until the following month, so that we need to reduce, and the current month expenses paid in the cash in the current month. Okay, so that we need to consider. Say for operating expenses, you can take an example, is 10 lakh. Okay, and there is a depreciation of 2 lakh. Okay, again, like out of this, I mean, whatever may be the expenses, cash expenses. Okay, 30% you are going to pay in a current period. Okay, and the 70% you pay in a next month. Okay, so this is basically the particular month. Say for the September I consider here. Okay, and for the August, these expenses are 12 lakh. Depreciation always static. Okay, so you need to calculate what is the disbursement for the September. So what happened? Like I mean, you need to consider here the 8 lakh for the calculation 30/70, and here the 10 lakh. Okay, so in current period 70% of 10 lakh we need to pay like in the next month. Okay, so August 70 August expenses, 70% of August expenses we need to pay in the month of September. So here it is 7 lakh, and the 30% of the current period, like 30% of 8 lakh, so 2 lakh 40,000. Okay, so operating expenses disbursement for month of September, 9 lakh 40,000. This way we need to consider. Okay, so that you need to keep in mind. Any doubt here? This way we need to calculate the operating expenses. The purchases we are calculating in the same way, the way we calculate for the receipt. Okay, and operating expenses we need to calculate like this. So always keep in mind the ratio and the frequency of the payment, and accordingly you need to make a plan. So consider the effect of account payable, other operating expenses, and the account payable wages. So you can see here, to forecast its cash disbursement for the September, Beckon divided its outflow into the following categories. So direct material, direct labor, overhead, operating expenses, capital expenditure, tax payment, and the dividend. Okay. So like 425,000 purchase in August, payable in September. Okay. 3,10,000 incurred and payable in September. Overhead in actual cost to be incurred and payable in September. So in actual cost to be incurred and payable in September, and the capital from the capital expenditure budget, none in the September, dividend 35 payable in September for the. So you just need to add because only the September portion they gave. Okay, so it is 11,85,000. 425, 310, 150, 145, 120, and the 35. That's why we need to do. Financing budget means, as I said, if there is a gap between the disbursement and the receipt, then we need to see how we are meet out this gap. Okay. So while calculating the finance, one point also I forget to mention, like cash receipt, maybe the 10 lakh just okay, and the cash payment or the disbursement is basically the 12 lakh, and the management want to maintain the 2 lakh as a buffer. Okay, so that also you need to consider as a disbursement. Okay, so it is basically the financing requirement is like 2 minus 2 lakh plus 2 lakh, so 4 lakh is the financing requirement. Are you able to understand? Even though the net deficit is 2 lakh, okay, but management want the buffer of 2 lakh. Okay, so now how much amount we need to raise? 4 lakh actual disbursement plus whatever may be the buffer. Okay, so we can see one illustration. Beacon forecast a beginning cash balance for September 1 is 80,000. The company would like to ensure that the ending cash balance is 50,000. So 50,000 what I just informed, like the closing balance or the buffer I need. In order to accomplish this, it planned to borrow 95,000 at the end of September for its established line of credit at the annual interest rate of 6%. So first interest payment would not be due until the October 31st. Okay, so this is basically means they calculate 95,000 on the basis of the difference in cash receipt and cash payment like this. Okay, so I think what is the same. So here you can see cash collection is 10.63. I'm just trying to meet out whether it continues with the example. Okay, 10.63. Cash disbursement is 11.85. No, it is not possible actually. So deficit is basically how much? Net deficit for a period. Period is basically 1.22. Okay, this is my deficit. Okay, then there is a opening cash of 50,000. It is given here. For sorry 80,000. Okay, so opening I mean it is a deficit. Okay, so that I can reduce because I have already available. Okay, so 1.22 minus 80. Point 42. Okay, and the closing is, this is basically the minus, and the closing is basically the 50. Yeah, so 95 would be the requirement approx. Closing cash they want to maintain the. Okay, so this is net deficit after adjustment of the opening balances or deficit. Okay, and they want to maintain the 50, so financing arrangement they need to make for a 95 like this. So this way we need to find out what is my financing requirement. So in financing requirement, whatever may be the opening and closing adjustment also we need to do it. Okay, so cash budget format. So Bacon cash budget includes beginning balance of 80,000 and the cash collection, which we already discussed actually. 10.63, cash payment is 11.85, and the letter of credit borrowing of 95,000. Okay. So prepare the cash budget will allow the company to end September with a cash balance of 53,000. Okay. So instead of 50, 53. So it is the same way. 80,000 is the opening. We need to add 1063 as a reset. Then we need to reduce total cash available. Reduce the 11.85. The ending cash balance before financing is 42,000. If I make a borrowing of 95,000, then I have an ending cash balance of 53,000. So this way we need to calculate. So requirement we need to calculate on the basis of expected opening and closing plus net surplus and deficit. Okay, so this way we need to prepare the cash budget. Any doubt here? Okay, so key component of the budgeted income statement include, okay, so pro forma income statement, the same way, means the selling budget, cost of goods sold, sales budget, cost of goods sold budget, selling and administrative expenses, which will give us the EBIT and then interest expenses, okay. And the pro forma balance sheet in the same way, the way we do the balance sheet and the pro forma statement of the cash flow. This is also the same, okay. Then capital budget, as we know, capital budget generally situation arises when the management decide to go for an expansion. Okay, so what happened if I'm target to dispatch the 40,000 quantity. Okay, and I have a sufficient. I mean, this is basically the sales budget. Okay, then but my production capacity is 30,000 quantity. Okay, so to make out the difference 10,000 quantity, there are two options. One is basically either you can subcontract to someone or you need to go for a capital expansion. So generally for 1 year, if this kind of deficit of the sales or the volume arises, then management may go for the outsourcing or subcontracting. But if they find this is the regular requirement, then they decide to make an investment. Okay. So whatever the investment required, for that we need to see or we need to prepare the capital budget. Okay. So capital budget is basically say for I need to go for a capital expansion and then I decide I need a 10 lakh amount, 10 lakh dollar. Okay. So out of this, if I have a certain investments, okay, say for the 5 lakh dollar, okay, so I'm going to the amount from I'm going to take the amount from this investment and the balance 5 lakh I'm again need to go for a financing. Okay, my capital budgeting is this one. My budget is this. Sorry, capital budget. Okay, but then this is basically the way of finance. Okay, so that is basically the capital budgeting. Then flexible budgeting. So already I already informed generally with respect to the sales, we need to change my budget. If there is a change in sales, then we need to change in the budget. Mostly it is, I mean, the sales changes, that's why the production changes. So mostly depend on the sales and production. And sometimes the sale is same, but because of recession, I find I need to, whatever the closing stock I plan, that I need to reduce. So this will impact to the production. So that's why the sales or production we need to consider. Okay. So in flexible budget include consideration of revenue per unit, variable cost per unit and fixed cost over the relevant range within which the relationship between revenue and variable cost will remain unchanged and the fixed cost will remain stable. So again, whatever the assumptions we consider at the time of master budget, same carry forward here. Okay, only changes is with respect to the sales volume, because of sales volume. So generally variable cost per unit, all material, variable overhead and everything, that is same. Okay, and the fixed cost in total is same. Okay, variable, total variable cost may change, but variable cost per unit in a flexible budget is same as compared to the master budget, and the total fixed cost is same as compared to the master budget. So if you can see here, flexible budget include consideration of revenue per unit, variable cost per unit, and the fixed cost over the relevant range within which the relationship between revenue and variable cost will remain unchanged, and the fixed cost will remain stable. Okay, so this way you need to consider. Say for, like, if I consider the sales of 10,000 quantity and the price per unit is 5, so it is 50,000. Okay, now the COGS I consider in total. Okay, this is maybe the 3, so it is 30,000. Okay, then variable SGA. Okay, I mean the fixed variable you can consider in the same way, which is basically the 1 rupee, so it is 10,000. Okay, and then the fix, and the fix overhead, all SGA mostly. Okay, okay, if I consider in absolute 5,000, okay, and the profit is then 5,000. If it is come to know the sales quantity change from 10,000 to 5,000, so this amount same, this amount same, this amount same, so but this get changed. Okay, so it is 25,000, 15,000, and the all variable total number get changed, but the per unit is same, sales and variable per unit, and here the 5,000. Okay, fixed overhead in totality it is same, so it is 5,000 again, and then you need to calculate. Okay, so it is 15 plus 5, 20, and so there is no profit. Okay, this is minus minus minus, this is minus minus minus. So what happened, sale price per unit and the variable cost per unit is same, and the total fixed cost is again same. Okay, fixed cost per unit may change. Okay, so that we do in a flexible budgeting. So again, like all the assumption which we carried in a master budget, that carry forward to the flexible budget, only because of sales or production, whatever may be the number get changed, that number we need to change, quantity wise. Okay, so benefit of flexible budget can display the different volume level within the relevant range to pinpoint areas in which the efficiencies have been achieved or waste hour has occurred. Okay, see what happened if I do the means in the same way. So out of this 30,000, the 15,000 is related to the, means because of drop down of the sale, the cost get changed. So you cannot find out the variation whether it is favorable or unfavorable. So that's why whenever you are comparing with the actual situation, you need to first convert the master budget to the flexible budget, and then you need to compare with the actual situation. Okay, and the limitation flexible budget are highly dependent on the accurate identification of the fixed and variable cost and the determination of the relevant range. So that is important. Okay, so we can take this example. The flexometric corp produces flexometric corp produces the flexometric, a piece of exercise equipment. Corporate controller Flexsister is developing a flexible budget. So Flex has already developed a master budget, but the estimate that relevant range extend 20% above and below the master budget. Okay, so master budget they gave 300,000. Okay, so here if you see, the 200,000 is variable cost and the contribution margin is 100,000, fixed cost 100,000. So here if you see, means we did the 80% for the sales volume as well as the variable cost, but the fixed cost we kept as it is. Okay, and here the 120% of the sales volume and the variable cost and the fixed cost we kept as it is. So in a flexible budget, variable cost and the sell price per unit is same as master budget, and the fixed cost in total is same as the master budget. Okay, so any doubt till now? Okay, so ratio analysis, we just start the introduction. In detail, we will take it tomorrow. Okay, so like whenever you are doing a financial statement, so there are two type of one, the trend analysis. So it is basically you are reviewing a trend of a different period for same company. Okay, and then horizontal analysis. Listen, here you are evaluating the ratios with respect to same period for different companies. Companies. Okay, so this way you need to consider. Okay. So generally, we means we are reviewing the ratio for profitability. Okay, mostly the item related to the income statement. Then liquidity, mostly the item related to the current asset oblique liability. Okay, and then the solvency, mostly the item related to the non-current asset, means long-term asset or liability. Liabilities. Okay, so that you need to consider. And the performance matrix is basically, it is related to the various KPIs. Metrics. Okay, KPIs means say for defect rate. Defect rate. Okay, customer service time. Okay, so say for like if I consider the customer service time, okay, earlier average time required to solve one customer complaint, say for 5 hour, and now it is required a 3 hour. So what does it mean? There is a efficiency generated, but if it is a 7 hour, then it is inefficiency. Okay, so these are basically the performance metrics. So there are so many other criteria that we need to consider. Okay, so financial metrics. Okay, So generally, when we calculate the ratio, it is always numerator and denominator. Numerator and denominator. Okay. So with respect to something, we are calculating the performance. Okay. So if the numerator increases, that means the ratio increases. Ratio increases. And if the denominator increases, okay, then the ratio decreases. Okay, before going to this, if you have a like current ratio, okay, it is 1 or 1.5, and the same number you need to add in a current asset and current liability. Okay, so what would be the impact? Current asset and current liability. Okay, say for if it is 1.5, what does it mean? Okay, 150 divided by 100. Okay, so assume your total asset is 150 and the current liability is 100. Okay, and then you purchase some inventory on a credit. Okay, worth $20. Okay, so then what would be the resulting current liability, current ratio? Okay, purchase the inventory. What does it mean? Current asset increased by 20 and the current liability also increased by 20. Now you need to see the impact. 150 divided by 100, so it is 1.5, and 170 divided by 120. Okay, I purchased the inventory on a credit, so because of that reason stock is also increased. Okay, and the current liability is also increased, so it is 1.41. Okay, so whenever the same amount you are increase in a numerator and as well as the denominator, and the already ratio is more than 1. Okay, so your ratio is showing the decreasing trend. Okay, and if I consider the 0.8 as a ratio, 0.8, so what does it mean? 0.8 means 80, sorry, 120 and the 150. Okay, and again the same, like $20 I increases, so it is plus 20, and here also plus 20. You can see. So it is increasing. So here, if it is more than 1 and the same amount you added in current asset and current liability, then it shows the decreasing trend. And if it is less than 1 and the same amount you added, current asset and current liability, then it is showing increasing trend. The same way, if you reduce, say for payment to supplier with a cash, okay, so this will reduce. Okay, if this is the situation, then if you find this will get increase, reverse, and this will get decrease. Okay, so we can take an example like 150 divided by 100. Now it is 130 divided by 80. It is 1.5. Now it is 130 divided by 80. So it is 1.625. So it shows increasing. Okay. So when you reduce, if it is the ratio is more than 1 and you reduce the same number from numerator and denominator, then it shows the increasing trend. Okay. If you add like 120, 120 divided by 150 and you add the 20, so it is sorry, reduce the 20, so it is 100 divided by 130. Now you can see 120 divided by 150, it is 0.8. Okay, and now 100 divided by 130. So it is 0.76. So exactly reverse way. Okay, it is decreases. So if it is more than 1 and you add, the ratio get decrease. If it is less than 1 and if you add, the ratio get increase. If it is more than 1 and if you deduct the same amount in numerator denominator, okay, so then the ratio get increase. And if it is less than 1 and you deduct, then the ratio get decrease. That you need to keep in mind. Okay, so tomorrow we will see tomorrow we can see means the detail on it, means how we do the trend analysis and everything. Okay, any doubt till now? Anyone has any doubt? Okay, so if no one has any doubt, then maybe we can close the class. Yeah.
Okay, sir.
Yeah. Okay. Thank you, everyone.
Thank you, sir.
Yeah. Bye.